Hi there, welcome to Kneppy Invest. Time to talk Macquarie Group. This is almost a cult-like stock on the ASX, favorite company among a lot of private investors, retail investors, fund managers. In fact, when you do hear a lot of experts talk about the banks, they always say Commonwealth Bank is the best quality of the four big banks, but they do prefer Macquarie Group over all four of the big banks. So we're going to go into why this is cult-like stock on the ASX, why a lot of people like this company, and whether it is justified or not. For full disclosure purposes, I am not a current shareholder of this company. I used to be a shareholder going way back. In fact, when they spun off Sydney Airport, I was a shareholder back then. So I came away with Sydney Airport shares, which I then sold, and Macquarie Group shares, which eventually I did sell. Whether that's a mistake remains to be seen because the share price hasn't done much since did sell them quite a few years ago. Doesn't mean the share price is not in an uptrend, but the share price has been going sideways for about a few years. We'll say that's consolidating. And I think right now Macquarie Group does look almost attractive again, particularly with the share price pulling back towards $150. If the share price does fall below $150, I would become highly interested in taking a long-term position in Macquarie Group. Now to exactly what Macquarie Group does, and this is not a traditional bank, but they do have the traditional back part of the business, the service. But when you break down what this company actually does, in fact, the company breaks it down into two different types of activities: annuity style activities and markets facing activities. And when you break down the profit in the first half of financial year 23, now they did release their first half results either in October or November last year, and they will be releasing their full year results in May. So we're only 1 month away from that. But the profits for this company in the first half of financial year 23 was evenly split between annuity styles activities and markets facing activities, 50-50. Now, within these two activities, they've broken down this company into four different divisions. The first one is the banking, the traditional banking and financial services, and that provided 13% of the company's overall profit. Now, that's in the annuity style activities. The second part of the annuity style activities is Macquarie Asset Management, and that's exactly what it sounds like. It's asset management, and that provided 31% of the company's overall profit. Now, their biggest division by profit is commodities and global markets, and they actually separate that division into annuity styles activities, 6% of the profit, and markets facing activities, 37% of profit. So overall, commodities and global markets provided 43% of this company's profit. So some of the things they do in this division include risk management, helping clients manage exposure to price changes in commodities, currencies, credit, and equity markets, and quite a few other things as well. But this is, by profit, their biggest division. And the last division in the markets facing activities is Macquarie Capital, only provided 13% of the overall company's profit, but that includes advisory and capital raising services, equities brokerage, providing clients with access to equity research, etc., etc. So overall, this company is diverse, much more diverse than the traditional banks, and that's why this is not Macquarie Bank, it's Macquarie Group. Unlike the four big banks in Australia, who are all primarily domestic banks, Macquarie Group is an international global company. In fact, when you break down their staff, only 48% of their staff work in Australia and New Zealand, and the rest of the staff, 52% of the staff, work overseas, including 4,172 in Asia. So they have offices in Kuala Lumpur, Mumbai, Seoul, Singapore, Tokyo, Beijing, Bangkok. 3,338 of their staff work in the Americas, including Montreal, Toronto, Vancouver, Mexico City, Santiago, Boston, Chicago, of course, New York. They also have here Mission, Overland Park, and Walnut Creek. Have no idea where they are. San Francisco, Seattle, Orlando. So if you want to go to Disney World, maybe you can work with Macquarie Group and you can go to Disney World every single day. And 2,783 staff work in Europe, Middle East, and Africa, but they only have one office in Africa, that's in South Africa, Johannesburg, only one office in the Middle East in Dubai. They also have offices in London, Geneva, Frankfurt, Edinburgh, Vienna, Paris, Munich, and of course, Limerick. Now to the CEO. And one thing I did notice when I went through the management of this company, they tend to stick around with the Macquarie Group for quite a while. And there are some positives in regard to that. There's also some negatives, but I do like a stable management team. And definitely Macquarie Group has that. Where I work, we don't really have a stable management team. And a lot of the managers come from different areas and they don't grow in the organization. So they don't start at the lowest position and then work their way up. And I do think there is a disadvantage to that, not knowing how the company works from the bottom to the top. Now, the current CEO of Macquarie Group is Shamara. I'm not going to pronounce her last name because I'm going to completely mess it up. But she's been with Macquarie Group since 1987. So she's worked her way up. In fact, she spent time throughout the world with Macquarie Group. She spent time in New Zealand, Hong Kong, Malaysia, USA, and Canada. And she's been the managing director and CEO since late 2018. So I do like the very fact that she's been with this company for a long time. She knows how this company works, and she's been in this role for almost 5 years. Now to the quality of Macquarie Group. And now when I look at I do have a spreadsheet of all the companies on the ASX. And I do actually state in this spreadsheet whether a company is high quality, low quality, and I have a lot of in between in there. In fact, I've defined Macquarie Group as highish in terms of their quality. So not quite high, high-ish. And there's a few reasons why I've defined this company as highish, a few arguments to support why you would call Macquarie Group a high quality company. But there's also a few arguments to suggest they're not quite as high quality as they could be. So I'll discuss reasons behind that during the rest of the video. Now to some financial data for Macquarie Group, and this is the trailing 12 months data of revenue, profit, capital, and the last return on assets. And the reason I'm doing trailing 12 months is because they're just about to release their full-year results, and trailing 12 months is better than just using the previous financial year data because that's becoming out of date. So all I did was take the last half or the first half of this financial year and add it together to the second half of last financial year. Of course, you don't do that to the share price. Now, the share price of $169.60 was just the last time I looked at it. Share price today, I believe, has risen to above $170. But $169.60, the market cap of this company was $66.2 billion. Revenue of $18.2 billion in the last 12 months. Profit of almost $5 billion, so nice margins there. Capitalized, so really good capitalization here, $31.3 billion of equity or net assets, and the return on assets, 1.2. Now, one argument to say this could be a high quality company is just a consistent growth in revenue. But when you break down the revenue per share growth over the last 5 to 10 years, we only get a number around about 5 to 6%. So the last 5 years, revenue per share has only grown at 5% per year, and the last 5 years at 5.7% per year. And we saw a massive growth in revenue per share from financial year 21 to financial year 22. In fact, revenue went from $12.9 billion to $17.4 billion. That was a massive increase in revenue, massive increase in profit in 1 year. And I want to see if that can continue, because if that can continue, that sort of growth pattern, this company could be looking cheap right now. And I do think the market is a little bit pessimistic, not pessimistic, but a little bit skeptical that it can continue that growth moving forward just because of the PE ratio at this point in time. PE ratio is like 14. I've also included here on return on assets. And return on assets have been growing through time from 0.5 to current 1.2. And the end of last financial year, their return on assets was actually 1.5. So just based off the revenue growth, you could say this is a high quality company. But when you break it down to revenue per share growth, it's a little bit lower than I would like. And usually the number I'm looking for here is at least 10% growth in revenue per share. So that is an argument to say that this is not quite a high quality company. And the reason I'm looking for at least 10% growth in revenue per share is the best indicator for the future outperformance or the possible outperformance of a company's share price versus the market is revenue per share growth. We want to see really good revenue per share growth because, again, that is the best indicator for the future outperformance of a company's share price versus the market. Now, in this particular slide, I'm just looking at the profit history and the return on equity, and the profit has really grown at a faster rate than their revenue. And that's understandable because when you look at the return on assets, that has grown significantly over the past few years. So this company is becoming more efficient with their revenue, turning more and more of that revenue into profit. And that's something they can't do infinitely. That's why I do prefer good revenue per share growth. So in this particular slide, we're looking at income growth and also return on equity. And return on equity has been growing throughout the last 10 years. So again, this company is becoming more efficient, more profitable in terms of converting their revenue to profit. And I'm not sure how long they can continue this going. So from 2012, this company has grown their profit from 730 million to 4.7 million. And you can see a massive growth in revenue or profit from last year to this year. In fact, it's almost grown by about 50% from 3 billion to 4.7 billion. I did have a look to see why there was a significant growth in profit from last year to this year. There were some one-offs and also some acquisitions that did help that. But if you take away those one-offs and acquisitions, there was still quite impressive profit growth for this company. And return on equity has grown from less than or around about 6% back in 2012 to around 19% in 2023. That's a really good return on equity, and that is something a lot of investors out there do look at. And that's probably one of the reasons why a lot of professional investors, a lot of the experts would call this company high quality just because of the return on equity. That's a really good return on equity, 19%. Another way you could determine whether a company is high quality or low quality is just looking at the dividend history. And this is the dividend history of Macquarie Group going back through the last 10 years. And if you take away the last 3 years, 2020 to 2022, and just look at 2013, 2019, that's a perfect example of a high quality company. Consistent growth in dividends. And then this company hit a bit of a roadblock, bit of a bump in 2020, affected by COVID-19 more than likely. And we've started to see dividends rise again. Haven't quite reached the heights we saw back in 2019. Not quite there, but I think 2023, we might see some record dividends for Macquarie Group. So this is almost the sort of dividend history that you would see for a high quality company. Dividend yield, 3.9%. Probably would prefer that a little bit higher, and franking, only 40% franking. So almost a high quality company when you look at the dividend history here for Macquarie Group. And that's another reason I probably would say this company is a high-ish quality company. Not quite high, but getting towards becoming a high quality company. Not quite there just yet. Now to some valuation metrics for Macquarie Group. And this is where it sort of gets interesting for this company. And if you believe that 50% in profit growth from last year or 2 years ago to the most recent year was not a one-off, they can continue that sort of growth. A P/E ratio of 13.3 is really low. This is why I think the market is a little bit skeptical that the profit for this company won't continue to grow. I think the market expects profit to fall in this financial year. In fact, the first half year results probably are showing that the results, in particular the profit, weren't quite as good as the previous half year, the last half year of the previous financial year. And that's why the P/E ratio of this company is only 13.3. It does seem low for a company that has acceptable growth in revenue per share, but has really good growth in return on assets and also return on equity. So you could argue this company is cheap right now at a P/E ratio of 13.3. And I probably would not argue against you right now. Price to book ratio 2.1, sort of a traditional metric for banks. But again, I don't think Macquarie Bank is a traditional bank. And using the price to book ratio, I'm not sure if you should use traditional banking financial metrics. Price to sales ratio 10.2. Oh, by the way, price to book ratio of 2.1 is pretty good for a bank. On the high side of the bank, you probably would say as well. And price to sales ratio, virtually ignore this for a lot of companies. 10.2 really tells me nothing about Macquarie Group. Also did a reverse DCF based off the earnings per share just to see the sort of growth this company would need to justify the current valuation. And you get an earnings per share growth of only 6.1%. And I think that number that sort of growth or expected growth for this company to justify the current valuation is also a sign the market is a little bit skeptical whether this company can grow their profit in the next year or 2 years. So definitely think Macquarie Group can grow their earnings per share at 6.1% per year over the next 10 years. So this is another sign that this company could be undervalued right now. Another way you can compare the valuation of a company, whether it's overvalued or undervalued right now, is just look at the P ratio or compare the P ratio right now of the company to its normal historical range. So this is the P history of Macquarie Group going back to the start of 2013. And you'll see here that very rarely does the P ratio of Macquarie Group fall below 12. In fact, it's done it twice in the past 10 years. The first time it happened was in 2016. And what happened in 2016 for those who were investing back then? That was the bottom of the mining cycle. And where does the majority of the profits for this company come from? Remember, 43% of their profit in the first half of financial year 23 came through their commodity section. So if we do see a downturn in the commodity area in mining, that could have a negative effect on Macquarie Group. And that's why the P ratio of this company fell to 10 in 2016. It fell to 8 during the COVID-19 financial panic and then rallied. In fact, the high point in the P ratio for this company was in 2021, just after the COVID-19 financial panic, when the P ratio of this company went as high as about 24.5. So right now at about 13.3, it's on the low side. And if the P ratio fell to below 12 or even below 10, I would become really interested in taking a position in this company. Now, you could argue that the P ratio right now is really low because of what happened with their profit in the previous financial year. And that was on the high side because of one-offs, because of an acquisition. And that's a definite argument. The P ratio is a little bit higher than it probably, or a little bit lower than it probably should be. And I definitely would take that argument, but it's still getting towards the low side of what you usually see for this company. Now, another really sound argument for calling this company a high quality company is just by looking at the chart. And this is a definite high quality looking chart with the share price going from the bottom left to the top right. So this is the weekly chart for the company going back to 2012. And the share price of this company has been in an uptrend since 2012. Share price has increased from about $20, $30 way back in 2012-13. Can't believe it was that low, all the way up to the high of 220. So if you held from about 2012 all the way through to 2022, you had a 10-bagger here. So there have been dips in the share price. We saw a bit of a dip in 2016. Share price fell from about $90 all the way to below 60. So nice little correction in the share price, but nothing too serious. Nothing like we saw during the COVID-19 financial panic when the share price fell from $150 to $70. And then we have seen a little bit of weakness in the share price during the past few weeks. In fact, when you look at the daily chart, there is no trend in Macquarie Group share price right now. So let's have a look at the daily chart just to see the lack of trend in this company right now. This daily chart goes back to May 2021. The reason I wanted to go that far back is because I just wanted to show you the nice uptrend in Macquarie Group share price. During 2021, the share price reached a high of about $270, and that high was on the first trading day of 2022. And then we saw weakness in the markets, particularly in tech companies. And that's one of the reasons why the share price of this company fell from $217 to a low of $150 on the first trading day of October. Nice rally since then, up to $195, particularly in January this year, sort of aligned with the overall market. But the share price has pulled back to $170. Now, my trading strategy or investing strategy for this company, particularly because I would consider Macquarie Group to be a highish quality company, it's all about the value. And even $170, I do see potential value with Macquarie Group. So if I saw the share price fall to $150, you not only would get a possible technical signal, like a double bottom, you'd also get a value signal as well. It would be approaching, or the valuation of this company would be approaching really attractive levels. And the share price kept on falling. This company will become even more attractive to value investors. And that attractiveness, when it comes to value, would help support their share price at those levels. So don't expect the share price to fall all that much below $150 if it does fall to those levels, unless we see significant weakness in the overall economy. And if we do see overall significant weakness in the economy, or we see a downturn in the mining sector, that's when we might see the share price fall significantly below $150. I plan to continue doing Kneppy's analysis for a while yet. And the next company I was supposed to do was Index. Then I realized I've already done a video on Index. So I replaced Index with two other companies, Advanced Braking Technology. Now, hands up, who's heard of that company? It's a micro cap company on the ASX. It is profitable. I've been following this company for about 10 years. Yeah, about 10 years. And they haven't really gained all that much traction until recently. So first time I've taken a deep look at Advanced Braking Technology. What they do is in the name, Advanced Braking Technology, short ABT. Also have a look at Santos, Mineral Resources, Supply Network, and Sonic Healthcare. If you do have a suggestion of a company you would like me to feature in Kneppy's analysis, leave that suggestion in the comment section of this video, and I'll see what I'm able to do. That's all I have for this video, this look at Macquarie Group. If you have any thoughts, any questions, any concerns, leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.